Everyone, this is MoneyPigTrading, and today's topic is when to stop loss and when to take profits. So just a highlight of our Q2 2020 earnings season earlier performance. So just a highlight, in total we sent out 63 alerts and resulting in 42 wins, which means the returns are over 0%. So that means the winning rate is 67%, which is pretty decent. And the average return per alert, just including options, but not include any stock trading, is 136%, which is pretty decent. So here's just some breakdown of the pre-earning play and post-earning play and their performance. And earnings season is coming, so please make sure you join MoneyPigTrading Discord channel to learn more about live alerts and grab the big wins in the Q3 2020 earnings season. If you haven't followed us, please make sure you check out our website, MoneyPigTrading.com. That will provide the sign-up steps for our Discord alert service and our education contents. And also, please make sure you follow us on Twitter, YouTube, and Instagram if you haven't done so for the most updated trading information and education. So today, three major topics is how to set stops, quick overviews, and also which metrics should we use to determine whether you should hold a position or not. And the third one is what kind of chart patterns with most highest chance of success. So how to set stops. So just to recap, we actually mentioned in the welcomes and rules channel in our Discord in the number 5. And here we're just going to quickly go through this writing in case you haven't read it as a member. Or if you haven't joined us, here just some high level, stop rules that we actually use. So first of all, we don't have any stop limit for lottos. Lottos are positioned below or equal to 50 cents per contract. Sometimes between 50 cents or $1 per contract, we also consider it as lottos. For option position, the stop limit order is set around 50% for the original entry price. Just a general rule of thumb, some people might ask, like, why not 35% or why not 40%? Sometimes for longer term swing trading, we know that stock is more volatile, like Zoom, Tesla, which the stock beta is very high, above 2. That means the stock is very volatile. So we're trying to capture the trend, but we know the stock can change very volatilely. So we might set the stop limit to like 35% or 40% of the original entry price. However, for stocks, warrants, ETN, ETF positions, the stop limit is usually set a specific percentage loss or slightly below technical resistance. The reason is because technical resistance usually a form of very strong support. So we don't just want to stop right on top of it. We want to set the stop limit slightly below it. So if the stock price hold above or at technical resistance, it won't trigger our stop loss. And also, general rule of thumb is do not average down option positions, because when we enter an option contract, if it is in a wrong direction or even just in consolidation, the price of the option contract will drop dramatically and very quickly. Unless we are in the right direction, that's the only time I would recommend to add or average up the option position, but do not average down. Also, it's okay to average down stocks, ETFs, ETNs, warrants, etc., especially if it's a long-term or swing trading position, because we have a very long time period, that will give us a lot of room. And also, but still, to set stop limit for longer term or swing trading positions. And also for 1F, especially for our stock trading or option trading, we always take a half of the position off at 100% revenues or profits, and moving the remaining half of the position with a stop limit order slightly or at the entry price. So by doing so, we'll make the trade 100% free and risk-free, right? Because if you have a half of the positions over or at 100% revenue or profits, that means even though the other half you lost 100%, that still make a break-even position. So that will just make it risk-free, and it's a really good setup like we always recommend to use. And there's several type of stops. I know different brokers have provide very detailed writings and or videos, so I just highlight and put down their links and references. So if you have time, in total, these links will probably take you about 20 minutes to 60 minutes to digest. There are some basic order written by ThinkorSwim and some of the fancy advanced orders. And Schwab really have a really good video for stop versus stop limits. And also a lot of traders or investors, they actually haven't heard or don't use this bracket orders a lot. There's an awesome video by Schwab tell you what is bracket orders and how to use them. And actually can save a lot of time to put several different orders, but bracket orders can actually cover both sides. And also, there's a really good writing by Interactive Broker about trailing stops and trailing stop limit and their differences, and with some graph and mathematic calculation to show you their differences and how to put them. So it's really good. The other thing I really want to highlight really quick is about stop limit order. So when the market price is below our average entry price, I usually recommend stop limit order over limit order, stop order for stop loss. So in this case, you will see the SPY, the ask price, and the bidding price here is 3.88 and 3.92 respectively. And you will see here, we want to set a stop limit order. So we'll have a limit order and stop order. The thing I want to highlight is in the next slide, if your stop limit order, the price are too close from each other, your stop limit order might not be executed. So in this example, right, so if you want to stop at 1.9, but your limit order is actually 1.91, so once the market price reach not 1.91, the bidding price is actually probably 9.87, which is below your limit price 1.90. So in this case, your stop limit order won't be triggered, and it won't offer you production when the stock price is quickly dropping or against your position direction, against your favorable direction, right? So basically, the rule of thumb is try to get the delta of this ask and bid price, the difference of this ask price and bid price. So here will be 3.92 minus 3.88. That will be 0.04. So in this case, in the next slide, instead of putting the limit price 1.96, if you want to stop at 1.90, you should just put 1.94, which is 1.90 plus 0.04 equal to 1.94 as your limit price. So in that case, it will make sure your stop limit order does its job, not being executed too early and not being executed not being executed at all. And here's just some writing of what I just described. However, there's another thing is in option trading, if your contract is suddenly being pushed very out of money because the price changed dramatically, not in your favor, then in that case, the spread between the ask and the bid price might change dramatically. That's the time you might have to change your stop limit order manually again. This is really tricky of option trading, and that's why it's always a little bit complicated. And sometimes you can use this trailing stop limit, like I mentioned in the last two slides, to help you, for this volatile market. But sometimes when the market is so volatile, especially in a bear market, oftentimes you still need to manually adjust the stops. And the second topic is which metrics you should use to determine whether you should hold or stop loss a position. The short answer is use momentum indicators. Just to quote on Investopedia, so a momentum indicator are technical analysis tools used to determine the strength or weakness of a stock price. However, there are basically 20 momentum indicators. Which one should we use, right? So to be honest, they are all highly correlated with each other. Just choose the most common one and the one that you feel comfortable and the readable ones for you. I know some gurus will sell online on the internet saying that their indicator is the best, but as a PhD in machine learning and statistics, I really don't buy it because I haven't seen any journal articles or someone who can prove statistically significant, like his or her momentum indicator is better than the others. Often what I see is, one indicator is better than in one condition, while the other is better than the other condition. But generally speaking, there are three most common one. The first one is moving average convergence divergence, or called MACD. The other one is called relative strength index, or RSI. The third one is called TTM squeeze. MACD is probably the oldest and most common one. When my mom told me, yes, mom, I know you might be listening. When she taught me stock trading about 10, 15 years ago, this is the first momentum indicator she taught me. And it's widely used. I still like it these days. The other one I was going to highlight in this brief presentation is TTM squeeze. So just highlight MACD and TTM squeeze. Here is a GEMA, which is a stock like in the past 2 weeks in October 2020. A lot of traders are talking about it because it break the range. And you can see in July, this is a daily chart, by the way. So it pushed up and before earnings sailed off, break the trend, go into the bearish trend, consolidate here, and start to push up again in early October. And you can see for MACD, you can see actually cross the line here in the positive territory here, and it started to show green bar. That means the bullish trend started. And once the line started to cross over and you can see the bar color changed, that probably means the bullish trend stopped, which is right at the date of the earning. And then you can see the MACD actually remain red bars and until it cross again and it form a consolidation. And then once it push up to the positive territory with a more significant green bar, that means the bullish trend started again. The other way to look at it is this TTM squeeze. When the color change, that means, which is the same, as you can see, that's why I said they're highly correlated, because when the color change, that means the MACD also crossed. That also means a trend change. Here you can see GEMA start to push. The TTM squeeze show this bright color. The rule of thumb is once the chart time frame you're looking at, it show the color change for 2 bars, then that probably means it's a trend change. You probably need to take off your position. Here it turns into dark blue from light blue. Potential, pattern change or trend change, but again, the other day it becomes white blue again. So don't worry about it. Keep holding until it started to change into 2 dark blue for 2 bars, and which is equal to earning date, equal to the MACD crossover. That means you probably need to take off your position. And then the color change until this downhill bottom. That means this slope means this is a bearish trend. Until the color change, that means the bearish trend is going to slow down. That's the time. The second yellow bar is the time you should close your naked put position or your stock shorting position. And then you will see this yellow bar start to, getting narrower and narrower. And that means probably the stock is going to the consolidation stage, which means the red dots. And then you can see the green bar comes back again for 2 days. And then that probably means the bullish trend start to come back again. So here I'm favor the TTM squeezes slightly better because I think the chart is slightly more readable, at least in my opinion. But as you can see, they're highly correlated with each other, and they are basically telling us a very same thing, right? Just the momentum of the stock. So talking about chart patterns with high success, right? So talking about time frame, a lot of members, followers ask me, oh, should I hold this stock, right? But I oftentimes found that they're looking at the wrong chart in the wrong time frame, because when we issue a swing trading alert, we're trying to capture a macro trend that's last a couple days, if not a couple weeks or a couple months. So in that case, for swing trading and long-term investment, we use 1 hour, 4 hour daily and weekly charts. However, for day trading or any weekly, the same week expiration option contracts, we're trying to capture a very micro trend. So in here, we should just use 1 minute, 5 minutes, or 15 minutes charts. If you want to use TTM squeeze, I would recommend 5 minutes and 15 minutes chart. 1 minute chart might be a little bit too aggressive unless you really want to do day trading that keeps scoping, taking out position every 5 minutes and adding it back, every 5 minutes or 2 minutes. I would recommend 5 minutes and 15 minutes charts better than 1 minute. So here's a day trading using 15 minutes chart. This is FedEx, right? Monday, Tuesday, just consolidating. Wednesday, push up a little bit, drop back again over the after market sell off. And Thursday, awesome, all the way straight up. And Friday, push up again. And then Friday, at the end, sell off again together with the market. And if you look at this chart, you're like, this is not a very good stock to invest, right? For day trading, at least for this week, it's not very decent. However, when you look at this macro trend we're trying to capture, right, it's a range break, EMA curl, just shooting up. This is the trend we're trying to capture. So if you're looking at 50 minutes chart, you will be scared, like, should I hold this swing trading position, right? But here, if you look at the daily chart, it's holding all the EMA, or stands for exponential moving average, which are the colorful lines behind the stock price. And they oftentimes offer very strong technical resistance. And the stock price is holding above all this different type of EMA support, 4-day, 8-day, 15, 30, 50, and 200 days. And that's very, very bullish signs. And if you look at the MACD, even though they cross over several times, they'll still always be in the positive territories. If you look at the TTM squeeze indicator, you will see they're always in the positive territory as well. They barely turn yellow and red. They're light blue, turn dark blue a little bit, but still positive. That means this trend is still ongoing. So really, there's no reason we should take it off. The only time we should take off FedEx is like here, is light blue, dark blue, and then it started to show like red for 2 bars, and that's the time we should take off our naked call swing position on FedEx. Just another example, right? There are a lot of beautiful kelps along the California and northern Mexico coast. If you look at it from the top, right, it's like ugly, kind of dark, I don't know, kind of dirty kind of thing. But if you deep dive into the ocean, you will see how beautiful they are. They form actually gorgeous forest beneath the ocean with a lot of marine lives. Oftentimes you'll see fish, seals, etc. beneath it. So just 2 very different angles looking at the same thing will give you very, very different perspectives and feeling about the same item. So here, again, FedEx is one of our favorite these days because it breaks the long-term range, all-time high breakthrough, which always a plus. All-time breakthrough will always make the price follow up. Also, you will see the EMA curls that we briefly mentioned earlier. It hopes above the EMA support and curl higher. So these are very, very bullish, and definitely we should keep holding the position if we're holding one. And this is why we issue a FedEx swing alert on October 6th. We said, by November 20. So we're trying to capture this 6 weeks of trend before earning. And here's the earning price. What are the levels? Expect to reach what is the dollar and confidence level? Like how confident we are to this position. And then about 2 weeks later, 16 days later, the price is actually moving in our favor because this is a strong, again, chart pattern, all-time high breakthrough, EMA curl, break range. And as we expect, the swing trading position of returns 110%, and that's the time we take out half of the position and move the stop way above the entry price to protect our profit and holding this remaining half of the position for free ride, and hoping we'll get like more revenues, right, or profits. The other point here is range break and EMA curls, like Tesla, for example. Like those stocks are very sexy to trade. Everyone's talking about it, but they are oftentimes very high beta or beta. That usually means if a beta is higher than 2.0, that means that stock is highly volatile, right? Like Zoom, like Tesla. It's always very news driven, and so Boeing, right? Like when there's a news come out, the prices drop so much or move so much. Oftentimes, again, it's not in our favorable direction. So as you can see, Tesla, right? Like It breaks the range. It tried to break this range several times, but often failed. And you can see from the MACD and TTM squeeze as well. And we issue a Tesla swing trading for the earning play in the hope that it will break the range. But it does have the risk that this range won't break, because at least it was tried for twice, right? And this kind of NAND, usually I would recommend to take the profit faster than, names like FedEx, which is, more low profile, not a lot of people talk about it, is relatively lower beta, which is less volatile, but just keep going up. Stocks like, FedEx are like PayPal, Visa, MasterCard. Not everyone talk about it, but they're very profitable companies. Stock price is quietly pushing up. So just FYI. The other very common, chart patterns with high success is bull flags and bear flags. This example, JIMA again, here was a bull trend and holding the EMA support, EMA curls, and sometimes to touch the trend, consolidate, and push up again. This is called bull flag. And here again, we are seeing the bull flag again. It holds the bullish trend, touched deep down, deep over this trend a little bit, but pushed back the other day. So the flag is still holding on the daily chart. And you can see on the TTM squeeze, it's all still green bar, even though this day we break the bullish trend. And that's why I told a member to keep holding this position. And when a lot of members were kind of panicking whether we should hold this position or not, because looking at the daily chart, GMA still look very strong on daily. Again, because holding all the EMA support and also holding the trend, the TTM squeeze, and MACD both telling us, we should keep this swing trading position, which will expire like about 4 weeks from today. So. And here's on day trading. Here's another bull flag on SPY. You will see here is forming a bull flag, holding the EMA support, holding this uptrend. Push up, consolidate, push up again, consolidate is above EMA support, and finally at the end of that day in power hour, SPY finally break through, right? And on the daily charts, the same thing, right? So it has uptrend here, holding the uptrend bull flag, then break the flag, and then consolidate, and then some uptrend, holding, consolidate, and push up. And that's a typical bull flag, and it actually occurred across the market and several individual stocks since March 2020. And yeah, that's pretty much the presentation today. I know you might have a lot of follow-up questions. Please feel free to message us on social media or our Discord private channels. And thank you for your time, and thank you for listening.